This is Scott Becker with the Becker Business and the Becker Private Equity Podcast. We are thrilled today to be joined by two brilliant leaders from JP Morgan Chase and Company. We're joined today by Danny Resnick and Abe Porto. They're going to talk to us about sort of the retirement consulting program, the retirement consulting practice, and we'll talk about topical issues for plan participants, alternative assets in retirement plans, as well as what's topical for plan sponsors. Before I go further, I'm going to read a quick verbal disclosure from the JP Morgan team. And here it goes. JP Morgan Wealth Management is a business of JP Morgan Chase and Company, which offers investment products and services through JP Morgan Securities LLC, a registered broker-dealer and investment advisor, member FINRA and SIPC. The Defined Contribution Consulting Program is an advisory program. This is a paid media appearance. The speaker's opinions belong to them and may differ from opinions of JP Morgan Securities LLC and its affiliates. Investing involves market risk, including possible loss of principal, and there is no guarantee that investment objectives will be achieved. Past performance is no guarantee of future results. Alternative assets involve higher risks than traditional investments and are only for eligible, sophisticated investors who have capacity to bear the risks. Danny, Daniel, and Abe, can I ask you to take a moment to introduce yourself and tell us a little bit about the retirement plan consulting practice?
Absolutely, Scott. This is Danny Resnick. Happy New Year, everybody. Thanks so much for having us. So for the last 17 years, I've led the Resnick Group at JP Morgan Wealth Management. We are a four-person wealth management team based in Chicago, overseeing over $1.3 billion in assets. Today's topic is employer-sponsored retirement plans, and consulting on these plans is a core focus of my team, which is a natural segue for me to hand it off to my colleague Abe to introduce himself.
Thank you, Danny. And Scott, thanks for having me on, and Happy New Year. I'm Abe Porto. I lead JP Morgan's Defined Contribution Consulting business here in the U.S. I've been in the retirement plan business for about 25 years, have experience with a large national record keeper, as well as running retirement plan and institutional consulting businesses for some of the largest financial services firms in the industry. Here at JP Morgan, I lead a team of sales and investment professionals who deliver ERISA fiduciary advice and support to the firm's institutional clients.
Thank you. And we're going to talk really about three or four things. What issues are topical for plan participants, how alternative assets are starting to play into retirement plans, and finally, the issues that are topical for plan sponsors. Danny, let me ask you to kick off. What are the key issues that are topical currently for plan participants?
Yeah, absolutely, Scott. So I think a lot of conversations that we're having with investors revolve around the equity market strength that we've seen for 3 straight years now since we've turned the page on 2025. So, and as we speak here, the S&P 500 coming off 3 strong years, like I said, and basically sitting right around an all-time high. So the question is, are markets overdue for a meaningful pullback? And I think the answer is a definitive maybe. Timing pullbacks is a very difficult sport to play. And that's because investors need to be right twice, right? If you're going to quote unquote time the market, you have to sell at the right time and you have to buy at the right time. And so an interesting anecdote, Scott, we've as a firm published research showing that since 1970, investors have not been any worse off investing in the S&P 500 at an all-time high compared to investing at a non-all-time high. And this is held true on average over 3, 6, 12, and 24-month time horizons. So our conclusion from that data is that for long-term investors, time in the market is better than timing the market. Now, Scott, that being said, because equity markets have performed so well, many retirement plan portfolios now have an equity weighting that has drifted higher than the intended target. So some retirement plan participants build their own portfolios. We call this the do it myself plan participant. These plan participants might consider rebalancing their portfolio back to their target allocation if their equity weighting has drifted meaningfully above their intended target because of the strength that we've seen over the last several years. Now, alternatively, those plan participants who've been choosing the increasingly popular do it for me option of target date funds, they have a portfolio management team making that rebalancing decision on their behalf. And so, Scott, for listeners who aren't familiar, target date funds are globally diversified multi-asset funds whose risk level declines on a glide path as plan participants approach their projected retirement date.
Thank you very, very much. And I love this concept of if you're trying to time the market, you've got to be right twice when you buy and when you sell, or when you sell and when you buy. Talk a little bit about rebalancing. Does it happen incrementally at one time? How do people look at rebalancing when their equity percentage might have floated up higher than their target percentage currently? How do people look at that if you're a plan participant or if you're an investor?
Yeah, absolutely. And some of this comes down to personal preferences, Scott. But I think in general, depending upon the magnitude, of the overweight or the drift, investors can rebalance either all at once, or perhaps they can do it incrementally in a couple different tranches over a month or two. And again, I think I would just reiterate that every investor's financial situation is unique to themselves to help make that decision.
Thank you. And Abe, let me turn to you. We're on the Becker Business and Private Equity podcast. We should discuss the potential, the movement towards alternative investment options, such as private equity, hedge funds, real estate, and 401k plans. Give us a sense of what you're seeing here. These investments traditionally have only been available to accredited investors. How are 401k plans and retirement plans starting to look at this alternative asset universe?
Thanks, Scott. This has been a topic du jour lately. And, there has been some uncertainty around like when and if alternative investments will enter the 401k plan menus. And I think the answer is we do expect the industry to dip its toe in slowly. Broader adoption likely starts with a small allocation inside those target date funds that Danny was just talking about. What we don't know is if the target date fund suites will create new funds to hold an allocation to alternatives, or if alternatives will be included in existing funds. Also, I think that we expect evergreen fund structures may be more suitable for 401k plan menus as opposed to more traditional drawdown funds. And this is because investor capital gets invested right away, limiting cash drag, and then they tend to offer more flexible liquidity terms than drawdown funds as well.
Thank you. And to follow up on this, in terms of sort of alternative investing, using alternative investments in retirement plans, we've talked already about plan participants, sort of topical issues for them, and part of that's rebalancing, timing the market, investing in all-time highs. We've talked about alternative investing in plans, and that's obviously a topical issue for everybody, trying to see how that evolves, whether it becomes widely available or still a little bit more narrow, or what that looks like and how people approach that. Danny or Abe, Danny and Abe, we've talked about the issues that are topical for plan participants. We've also talked about this evolving world of alternative investing and alternative assets in retirement plans. Abe, talk to us about what are the most topical issues for plan sponsors, and also as part of that, who will make the decisions around if we're looking at alternative assets, we're looking at funds, which funds go into a lineup, and talk a little bit about the process of evaluating funds and record keeping for funds, because I know those are key issues for plan sponsors. Talk a bit about the topical issues for plan sponsors.
Absolutely. So when you think about who's making the decisions on which funds go into the plan, the responsibility for selecting the funds offered to the employees really falls on the plan fiduciary. Now, for smaller businesses, that could just be the business owner. And for larger companies, They might actually have an investment committee. In either event, this is where JP Morgan comes in and helps make that plan fiduciary's life a little bit easier when we think about fund evaluation and record keeper evaluation. So when we think about fund evaluation, we employ an experienced group of subject matter experts here from various disciplines across asset classes. And we meticulously assess both passive and active strategies that might be in these fund lineups with a combination of qualitative and quantitative diligence. And the punchline really is we start to look at these funds in the plans, we evaluate them, and we'll look at things like historical performance, and then we'll make recommendations based upon what the client is looking for.
Thank you so much. And talk about just for a moment about record keeper evaluation and how you deal with that.
Sure, an important part of the entire 401k process is the record keeper. So not that different from how we look at funds. So based on the unique needs of each institutional client that we work with, we'll conduct a comprehensive review of the record keeper's business practices, their operational infrastructure, their client service operations, and then we'll do an analysis based on that. And the punchline again here is similar to the investments. We want to make sure that the level of service is appropriate for the company and it's meeting expectations. And we're also want to keep an eye on the price comparable to plans of a similar size. So benchmarking by itself, whether it's the fund evaluation or the record keeper evaluation, it's critical and is something that plan fiduciaries should be doing every couple of years to help mitigate risk.
Thank you. And then one final question. In terms of plan sponsors, walking this fiduciary line between trying to include funds and balance risks, any thoughts around that? And then the approach that you'll take with clients in terms of the speed and the pace at which you'll start to include alternatives. How do you think about those things for plan sponsors, Abe or Danny?
Yeah, Scott, great question. Really very topical. We do think that plan sponsors could have a fine fiduciary line to walk, especially if they start to feel a little pressure from plan participants to include alternatives in fund menus. If this topic continues to receive the kind of media attention that it has, and it's really balancing on the one hand the potential benefit of including alternatives in fund menus, and on the other hand, there's risk that something goes wrong if and when alternatives start to be included in fund menus. And I think one of the themes that we've had during this conversation, Scott, has been incremental change, and that can be the rebalancing decision at the plan participant level, and the process of record keepers and plan sponsors potentially adding alternative investment vehicles and fund menus. And plan fiduciaries are often wearing multiple hats. Whether it's the owner of a business, the CFO, the head of HR, these are the types of people who tend to be in that fiduciary role as a plan sponsor. And because they're wearing multiple hats, we think it's good fiduciary hygiene to take what we call a crawl, walk, run approach to making changes, whether that's fund menu changes or whether that's evaluating record keepers. And that crawl, walk, run approach has definitely been resonating with our clients, given the ever evolving landscape here.
Thank you very, very much. Danny Resnick, Abe Porto, JP Morgan Chase. I want to thank the both of you for joining us today on the Becker Business and the Becker Private Equity Podcast. Again, we've had a wide-ranging discussion of thoughts for plan participants, alternative asset investing in retirement plans, and thoughts for plan sponsors. I want to thank both of you for joining us on the Becker Business, the Becker Private Equity Podcast. Thank you very, very much.
Thank you,
Thank
Scott.
you.